Okay, ladies and gentlemen, markets have been open for 6 minutes. Let's get down to business. The yield on the 30-year U.S. Treasury bond has hit its highest level since 2007, as investors remain very worried about inflation and government borrowing. So what does it mean for the state of our economy? Joining me now to discuss this and more, Scott Lincicome, Vice President of General Economics at the Cato Institute, and Greg Ip, the Wall Street Journal's Chief Economics Commentator and Deputy Economics Editor. Okay, Greg, why is this happening, and what does it mean for the average American who is not focused on the bond market?
Okay, there's several reasons that long-term interest rates, which is what bond yields are going up. First of all, I think there were a lot of hopes that the Fed could cut interest rates this year, but inflation has been sticky. And with the war in Iran pushing up the price of oil, nobody thinks that's going to happen. So that's one factor. Another is that we have this federal deficit, which is approaching, actually topped $2 trillion this year. The federal debt is approaching $40 trillion. All that borrowing is pushing up interest rates. And the Treasury is now competing with all the companies building AI data centers who have to borrow money for that. So that's pushing up long-term costs. And finally, it's a global phenomenon. You look at Japan. Japan is also seeing rising long-term interest rates. What does that mean for the average family? Well, things like mortgage rates and business borrowing rates, those are all essentially benchmarked to the long-term Treasury yield. So what you're seeing in the bond market is making borrowing more expensive for every business and household out there.
Here's what's really interesting to me, Scott. In the early days of the Trump administration, the bond market and bond yields specifically seemed to be the only guardrail for President Trump, right? He even appeared to back down from certain announcements when rates would go up. It seems like that's not the case anymore.
Well, he doesn't have as many levers to pull, I think, is one of the issues. When bond markets freaked out after Liberation Day, the president could go and negotiate a bunch of deals and lower the tariffs and exempt a bunch of stuff. And that could cause bond markets to chill out a bit. This time around, well, the tariffs are already lower and he's not going to get rid of them entirely. Yes, he could end the Iran war, but that's easier said than done, whereas he's learning. And quite frankly, there's no interest in Washington or in the White House to address the debt, and which being driven by profligate spending and a bunch of tax cuts as well. So there aren't any levers that he's at least willing to pull.
Do you know what's amazing to me? The fact that Washington has no interest in addressing the debt. Months before President Trump won, I saw Scott Bessent speak at an event, and he was practically foaming at the mouth of why we needed to elect a Republican, because our debt and deficit crisis was so disastrous. It was putting the future of our country at risk. And now here he is as our Treasury Secretary, and it's like we're pretending the debt burden is no big deal. I want to ask you about this new op-ed in the New York Times arguing that stagflation, and I know that's not something people here focus on a lot, but stagflation from the 1970s is back. Rising prices, slower economic growth. What do you think about that, Scott? Because if it is, that's bad news.
Yeah, I don't think we're at the full-on 1970s stagflation yet, but certainly you're seeing some signs of mini stagflation. Inflation, especially if you look at the PCE index, which is what the Fed cares about, is still well above that 2% benchmark. Core PCE is now around 3.3%. And outside of the AI boom, which, look, has been very healthy, that's a big tailwind. But outside of that, everything else has been pretty tepid. You throw in slowing demographics, immigration restrictions, all those tariffs and all that uncertainty. And I think you're getting this mixture of not really high 1970s inflation and 1970s growth, but a miniature version of that.
And Steph, if I could just jump in here for a second, I think that if we sort of use one term, stagflation, it sort of obscures the fact that we really have two economies here. If you're anywhere in the corporate sector, this is not stagnation. This is boom times. The economy is growing. Profits are up. Profit margins are at a record. The stock market hits record after record. It is a great time to be a corporation right now. And that's the big driver of the growth that we do have, around 2%. If you're a worker, not so much. I mean, we know, for example, that because of the stickiness of inflation, average hourly earnings are basically flat to slightly negative when you adjust for inflation. So I don't think it's so much a stagflation writ large story. I think there's a two-track economy where the average wage earner is struggling with stagnation, but everybody else, especially in the corporate side, doing pretty good.
And what will be the impact of that, Greg, because, pile on to that. Think about all the companies that are now getting paid back tens of millions of dollars from the government because of the tariffs that the Supreme Court deemed unlawful. Those companies are now facing somewhat of a windfall, getting all that cash back. But the American consumer who paid up during the time of tariffs, which in some parts we're still in, we're not getting a refund check.
Well, so a couple things. We know that a lot of the tariff costs were absorbed into company profit margins. So it's not that surprising that they're responding to the refunds by padding their profit margins. But on the positive side, it probably means that we're going to have lower inflation, at least from imported goods in the coming year, because we're not piling on additional tariffs. It's sort of like the feels so good when it stops phenomenon. At the same time, but I do think there's a bigger picture here, Steph, which is, for example, in July, we saw zero job growth. In fact, 5 of the last 12 months, we had negative job growth. And I think that speaks to the risk in the next year or two that as companies find more ways to deliver goods and services with fewer people or the same people that they already have because of AI, we're in kind of like a jobless boom right now.
A jobless boom sounds slightly scary to me. Quickly before we go, because we're talking tariffs, Scott, Canada is set to face new ones as high as 50% midnight tonight. You think this is going to happen? Canada.
I don't think it's going to happen. I think
I hope
for
you're right.
2 reasons. One is the statute the president is invoking here has never been invoked. I think they in the White House know that this is a very risky gamble. They've already been smacked down by the courts a few times here. And I think the Canadians also know this and are willing to budge on a few of Washington's demands to make this all go away. My guess is that a bit of a tempest in a teapot. I think it will go away before any of this stuff happens.
I hope you're right. Gentlemen, thank you for joining me this morning.